Welcome. Let's get straight to it. Your success at this firm depends on mastering the two great engines of modern investing. The first is the art of business valuation, really understanding a company's soul, its fundamental worth. The second is the science of quantitative analysis, the ability to find a clear statistical signal inside all that market noise. To truly excel here, you need to become fluent in both. So, let's begin.
This quote from Warren Buffett? It's the bedrock principle that governs both disciplines we're covering today. For the value investor, patience is waiting, sometimes for years, for a market price to finally reflect a company's true intrinsic worth. For the quant, it's the patience to trust a rigorously validated model, even when the market is in complete chaos. In both worlds, patience is the ultimate discipline.
All right, our first paradigm, value investing. Think of it as the art of seeing a business for what it really is. You see, in the short term, the market acts like a voting machine. It's driven by popularity, by sentiment, by hype. But over the long term, it becomes a weighing machine. It assesses the fundamental substance of a business. Our job, your job, is to focus on the weight, not the votes.
Now, this philosophy didn't just appear fully formed. It's evolved quite a bit. It really started with Benjamin Graham back in the 1930s and his famous cigar butt approach. He was literally looking for mediocre companies that he could buy for less than their liquidation value, a last free puff. But by the 1970s, Buffett and Munger took a giant leap forward. They shifted the focus from buying fair companies at a wonderful price to buying wonderful companies at a fair price. They started looking for businesses with what they called economic moats, durable, long-term competitive advantages. And that was a critical jump, from just buying cheap assets to buying truly high-quality businesses.
So how do we actually estimate that intrinsic value? We have two primary tools in our kit. First, the discounted cash flow, or DCF. It's forward-looking, which is great, but it is incredibly sensitive to your assumptions. Remember the phrase, garbage in, garbage out? It absolutely applies here. The second tool is asset replacement cost. This gives you a really conservative floor value based on tangible physical assets. But here's its critical weakness. It completely ignores intangible assets like brand recognition and intellectual property, which, for many modern companies, are their most valuable assets by far.
Within this framework, there are two principles that are completely non-negotiable. First, the margin of safety. This is the buffer, the discount between what you calculate a business is worth and the price you actually pay for it. It is your protection against mistakes, bad luck, and a future that is fundamentally unknowable. Buffett insists on a huge margin. Second is the circle of competence. You only invest in businesses that you can fundamentally understand inside and out. Knowing the boundaries of your own knowledge is absolutely paramount. It's what keeps you disciplined, and frankly, it's what keeps you out of trouble.
Let's look at a classic example, Buffett's investment in Coca-Cola. This was right after the 1987 market crash. Everyone was panicking. Mr. Market was terrified. And that's when Buffett saw it, a perfect franchise with a global moat that was nearly indestructible. He paid about 15 times the earnings for it, which wasn't some huge statistical bargain. But he did it because he understood the qualitative value of that brand and its immense global growth potential, things that went way beyond the raw numbers on a balance sheet.
Now let's jump over to China, where Duan Yongpeng applied these same principles to Guizhou Moutai. Moutai has what you could call the ultimate cultural moat in China. It's practically a form of social currency. And the business model is just incredible. Its core inventory, which is aged liquor, literally appreciates in value over time. So a period of slow sales doesn't hurt them, it just creates a more valuable product for the future. This is a perfect illustration of how you apply universal principles within a very specific and powerful cultural context.
Okay, time to shift gears. We're moving from the art of human judgment to the pure science of data. Welcome to quantitative investing. The philosophy here is pretty simple. In God we trust, all others must bring data. The entire goal is to use mathematical models, massive computational power, to systematically exploit statistical patterns in the market. And crucially, the aim is to remove that unpredictable, emotional human bias from every single decision.
A lot of people hear quant and think of some magical, impenetrable black box. It's not. It is a highly disciplined, logical system. It all starts with data, the lifeblood of the whole operation. That data feeds a research engine, which is where you generate signals and model your risk. A portfolio builder then takes those inputs and optimizes them into a portfolio. And finally, an execution engine uses algorithms to place the trades, which in turn creates a feedback loop of new data, allowing the system to constantly learn and adapt.
So, the day-to-day work of a quant revolves around a few key ideas. First is factor discovery. That's the hunt for characteristics, like value or momentum, that can systematically explain market returns. Second is data supremacy. The edge today is increasingly coming from so-called alternative data, things like satellite imagery of parking lots or credit card transaction data. Third is rigorous backtesting, which is simulating your strategy on decades of historical data to see if it holds up. And this leads to the fourth and most critical concept, avoiding the cardinal sin of quant, which is overfitting. That's when you build a model that perfectly explains the past noise, but that completely falls apart in the real world.
When you talk about quant legends, you have to talk about Renaissance Technologies. It was founded by a brilliant mathematician, Jim Simons, and they famously hire PhDs in physics and computer science, not finance grads. Their core strategy is one of the most closely guarded secrets in the industry, but we know it's a high-frequency, market-neutral approach. Here's the crazy part. They don't even try to understand why a pattern exists, only that it is statistically significant and repeatable. Their edge on any single trade might be razor-thin, maybe a win rate of 50.75%, but by executing millions of trades with leverage, they compound that tiny edge into some of the most astonishing returns in history.
Now let's look at China, which for a very specific reason is basically a quant's paradise. Its A-share market is overwhelmingly dominated by retail investors, and this creates very strong, predictable behavioral biases, things like herd mentality and panic selling, that are just perfect for quant models to identify and exploit. But, and this is key, you can't just copy and paste a US model into China. The whole factor ecosystem is different. Classic momentum strategies, for example, don't work nearly as well, while value and reversal factors are incredibly strong. Firms like Highflyer Quant have become dominant by building massive AI and computing infrastructure that is specifically tailored to these unique market dynamics.
So, we've explored the art, and we've explored the science. Thesis, antithesis. Now let's bring these two powerful and seemingly opposing ideas together to see how they compare, and more importantly, how they can be fused into something even more powerful. This is really the central question for any analyst working today. You have to understand the fundamental distinctions in their worldview. That's the absolute first step toward being able to integrate them effectively in your own work.
Okay, let's break it down side by side. The philosophy. Value investing is all about exploiting human emotion, Mr. Market's irrationality. Quant is about systematically exploiting statistical patterns. The basis for decisions. For value, it's deep, qualitative business analysis. For quant, it's data-driven, algorithmic models. The time horizon can be years, even decades for a value investor, versus microseconds to months for a quant. And the key risk? For a value investor, it's the dreaded value trap. For a quant, it's model failure. These are truly different ways of seeing the world.
But here's the thing. You don't have to choose a side. The most effective approach, the modern synthesis, is what we call quantum mental investing. It's about fusing the incredible breadth of quantitative screening with the unmatched depth of fundamental insight. You're using the strengths of one discipline to cover the weaknesses of the other.
So what does this look like in practice? Well, think about it this way. A fundamental analyst can use quantitative screens to filter a massive universe of thousands of stocks down to a manageable list, maybe 100 promising targets that fit certain factors, like high quality and low valuation. You're combining the brute force scale of the machine with the deep dive intelligence of a human analyst.
And that synergy flows both ways. Deep fundamental research is the ultimate way to validate or even reject a quant signal. A model might flag a stock as statistically cheap, but it takes a human analyst to dig in and figure out if it's a real opportunity or a value trap that's headed for bankruptcy. This provides essential context that the raw numbers can, and often do, miss.
All right, let's bring all of this back to you. This section is about application. It's about your careers and how you are going to forge your own unique investment engine right here at this firm.
I want you to think for a moment about where you naturally fit. The pure value investor is like a detective, patient, deeply curious about business models, a bit of a contrarian. The pure quant analyst is the scientist, systematic, analytical, someone who trusts data far more than their gut. The ideal modern analyst, though, is quantum mental. They're bilingual. They combine the detective's relentless curiosity with the scientist's unwavering rigor. This is the profile we expect you to build toward.
So here is your development plan. Step 1 is your foundation. You must master the art. That means learning fundamental analysis, financial modeling, and how to truly assess a business. Step 2 is expansion. You will embrace the science. We will give you all the resources you need to learn Python and apply real statistical analysis. Step 3 is integration.
This is where you achieve fluency, using quant tools to make your fundamental research faster and more robust, and using your fundamental insights to ask smarter questions of the data. Your progression from analyst to portfolio manager will depend on this integration. So let me leave you with this final thought. Your path forward is not about choosing to be Warren Buffett or choosing to be Jim Simons. It's about studying both of these masters to construct your own unique, robust, and repeatable investment process. Stay curious, be incredibly disciplined, and never, ever stop learning. The market is going to keep posing the questions. Your process is what will provide the answers.
Now, it's time to get to work. And your first task is to start thinking about that final question you see on the screen. How will you fuse them? Welcome to the team.